Welcome back, everyone. This is Liz Faircloth.
And I am Andressa Gadelli.
We are the hosts of the InvestHER podcast. You know, Andressa, investors typically don't want to talk about insurance. They end up talking about it when they find out they're underinsured because some catastrophe happened, or they ignore it and they realize they're overinsured and they're actually minimizing all the cash flow they actually could be making in their property.
Oh boy, oh boy. Well, today we interviewed the co-founder of Steadily, Datha Santomieri, and we break down, Liz, more issues that are happening that people are not talking about. For example, a lot of folks are running 2 or 3 or 4 or 5 different types of exit strategies, right? You have long-term rental, mid-term, short-term, renting by the room. And the line item for insurance is still the same. And that is a problem, right? Many people have insurance from the old long-term rental, and now it's a short-term rental, but they have the same type of insurance. That is a problem, right? And now you're like freaking out. Don't freak out. During this episode, we will break it down. What do you need to do if that's your case, and how you can take the next step to make sure that you are insured properly based on your current strategy and you're not either under nor over insured in today's market. So when it comes down to insurance, many landlords might be saying, I'm good to go. I have homeowners insurance. I am all set. And that is far from the truth. So we're going to start this podcast just clarifying that piece. Many should have landlord insurance and they don't. Let's get that clear, Datha. Explain to us the difference between homeowners insurance and landlord insurance.
Definitely not the same thing. You shouldn't assume that because you have homeowners insurance that you're all set from an insurance perspective on your investment property. A homeowner's insurance policy is intended to cover a place where the owner lives in the property. And most of them, even if you are living in the property, you're renting out the other half, or you have some sort of home share situation where you're Airbnb-ing out a portion of it, they may have an exclusion on there that says you're not allowed to do those things. And so the problem is that you may have successfully purchased the policy if they perhaps didn't ask the right questions or it didn't come up in conversation. You may have been able to purchase it, but when it comes time for the claim, when you need to go collect against the insurance that you've paid for, if it then comes out that that property is being used for something other than what the insurance company believed it was being used for, they can deny the claim and you will have no coverage. So it's not a question of were you able to successfully buy it? It's a question of, is it going to cover you at the time you have that claim?
And I remember having that conversation many years ago when Airbnb was not as popular as it is right now. And I did ask my insurance company after the fact that I was renting my property to Airbnb. And I was only renting when I was gone on vacation or traveling, that type of deal. And her answer was like, I don't know. At that time, they didn't. She was like, I don't know. I think so. And then I started asking around and people were like, you're fine. Airbnb has this $1 million insurance. So how would you address that, Datha?
That insurance is not really for your property. There are things that it covers, but that is not going to cover if a guest leaves a candle lighted in the property and they leave and the building catches fire and burns down. You don't have coverage for that through Airbnb. They're not going to pay to rebuild your home. And if you're carrying just a basic homeowner's policy, an inspector is going to come out to review the terms of that claim. They're going to ask a lot of questions. They're going to look around the property, and then they're going to realize you weren't actually here when it happened. Somebody else was. Oh, you're renting it out? That's an exclusion under your policy. This claim is denied. And that happens frequently when people do not have the right coverage.
So Datha, I'm curious, so many women, I think, and so many investors are shrewd, right? We don't want to overspend. We'd rather not have insurance that we're never going to use, but we want to be protected. And we really obviously want to protect such an asset like real estate. So that's probably an agreement, but we just don't want to be overinsured, right? I think that's probably a common, piece for so many investors. How do we go about looking at our current assets, looking at our current investments and saying, are we over or under?
Insurance is all about your threshold for risk, right? All it is covering risk, just like anything else. So you kind of have to ask yourself, what is your tolerance for risk? If you are also a contractor, you do most of the work yourself. You know, if something goes wrong, you're probably going to be the one who goes in there and fixes a few things. Then you may opt for a policy with a much higher deductible that's going to keep your premiums a lot lower. You might opt not to add the bells and whistles on because you know you're just going to take care of it yourself and it'll be cheaper for you to handle it. If you're not, and you're somebody who is going to have to farm it out to somebody, you may need to think about purchasing a smaller deductible because can you handle that? Could you output $10,000 to repair something up front if you're not able to do it yourself, if you're carrying a really high deductible on your policy? So that's one thing that you can do.
I like that. I'm curious, how does property management play into it? So say I have a third party manager who's managing those tenants and managing, whatever type of tenants I have, which I have another question about in a second. But if I have a property manager, how does that impact how much or how little insurance I should get? Does it impact it? I'm curious.
Well, most the property manager doesn't have an insurable interest in your property. So if your building burns down, to them it's like, okay, I'm sorry your building burned down, but it doesn't impact them financially. Where your property manager is going to care is on the liability side of things. And that is where, if you have a loss, that's likely to be where the largest cost is going to come from. Now, it's less likely. You're much more likely to have a fire, water damage, something to the actual building. But those landlord policies also include liability for you as the landlord. And if something happens, if somebody injures themselves on that property and they choose to sue you because you're the owner of the property, it doesn't matter if it's right or wrong. It doesn't matter if it's fair or valid. You still have to defend it. And so that's where that liability is critically important. And the property manager wants to be listed as an additional insured because they could get pulled into the lawsuit too, because they failed to fix the steps or something like that. And so they get looped in. They want to make sure they have protection under your policy.
So when investors are looking at different options, exit strategy, long-term rental, short-term rental, or mid-term rental, renting by the room, I think one of the biggest mistakes that they make is to put the same amount of insurance across the board, and that's not the case. So how can they adjust accordingly based on the exit strategy?
When you have a short-term rental or a midterm rental, you do have higher exposure than when you have a long-term rental because you've got more people, you've got more foot traffic coming onto your property. And so you may want to consider having higher limits than what you would have if you just have a traditional tenant. I would say the minimum that we would sell is $100,000 in liability. But that's the minimum. Better is $300,000. That's probably the average of what we offer. But if you have a short-term rental, you may want to consider $1 million because you just have a lot of people coming through your property and you don't know them. You don't have a relationship with them. You don't know what could happen. When we talk about the cost of that, yes, the more liability you purchase, the higher it's going to cost. And you can expect, as you're thinking about your cash flow and in your return on investment, a short-term rental is going to cost more in insurance than a long-term rental. And a long-term rental is going to cost more insurance than a homeowner's policy because the risk is going up. It's a riskier prospect to the insurance company.
Needless to say, it costs much more when you have a problem. When something really bad happens to your property. I want to understand a little bit better in terms of short-term rental, because I don't know if things changed or not, but in the past, as the products were being developed and the service were being developed, there was two different types of insurance that I was aware of. One that did cover when people were renting the house, but did not when the property was vacant. Is there a specific clause? Because I want to make sure that, at least my property is covered when it's occupied and when it's vacant. And I think that a lot of folks don't check that. And that was actually not my case. And I had to adjust my insurance when I found that out.
Yeah. So almost every policy is going to have an exclusion for extended vacancy. Policies understand this is an investment property. You're likely to have a few weeks in between renters as one person goes in and one person goes out, but that's usually a max of 30 days. So you should check your policy and see what it says about that permissible vacancy period. Because if you go longer than that and your property sits empty for 3 months, that has now triggered the vacancy exclusion. So if something happens, like let's say a water pipe bursts and you haven't been in there and it sits there for 3 months and now you have mold and you have rot and you have all this damage that you have to address, it is potentially going to be excluded if the insurance company finds out that property has been sitting vacant for a period of time because they expected that you or someone was in that property checking on it, taking care of it. So you do. And also if you are a flipper, so if you're doing renovations on properties that are extended and they take a while, that is not a traditional insurance policy. That's not a traditional landlord policy. You need to seek separate coverage for that period of renovation while you're doing that.
I have a follow-up question on that. For the construction piece, I usually have my name on my company and or added as an additional insured under the contractor's insurance company. So what you're saying is that on top of that, I also should have, which I believe, now I'm like, wait a minute. Was that or not? Now I like question mark. I'll call you right after this episode data to look at it. So you're saying that one thing does not exclude the other. Is that what I'm hearing? You should have them adding you and your company as additional insured, plus have insurance for your property while it's under construction.
So we're talking about separate things. And yes, those are two very different things. When you ask your contractor if they have insurance, what you're making sure is that when they're on your property and they're doing things, if their employees fall and hurt themselves, if they do something that causes damage, then you can later come after them and know that they have insurance. That is not the same thing as you having coverage for your property during the period of time that it's under renovation. So let's say you're renovating your property, you have a contractor, they have insurance, but there's a hailstorm. And during that hailstorm, it damages the roof that you just put on that property. If you don't have an insurance policy that covers you during that period of renovation, you will have no coverage. It's not like you're going to go after the contractor's insurance. It wasn't their fault. So you still have to keep that property insured. What if someone walks onto your property, onto the job site? That's not the contractor. That's you because you own that land and it happened on your land. So you do have to keep an insurance policy on it during the entire period that it's under renovation.
So just to clarify, and add me / my company or whoever as additional insured under their insurance.
It is usually not common from what I've seen for a contractor to add the property owner as an additional insured under their policy. That's not usually common. I suppose you could ask them to do it, but that's not something I see done frequently. You have your insurance for your property. They have their insurance for if they do something in the course of their work as a contractor. So both of you are covered. And if there's ever a discrepancy about who was responsible, then your insurance companies are going to fight it out and decide, who's liable for which part. But I would say it's not common. And I don't commonly see contractors being listed as an additional insureds on your policy. The property managers are, but I don't commonly see the contractors.
No, it's quite the opposite. Me as the owner of the property and or my company are listed under the contractor's insurance because I'm walking that property. And so that's something that it's a non-negotiable for me on the construction side, and that goes on theirs. But I wanted to double check one thing. We talked about underinsured, right? We're all like, should we under? How do we know we are like overinsured? Does that ever happen? And how do we know that?
I think overinsurance can come into play when you maybe have multiple policies that are covering the same thing. So it's not necessary for you to carry it. If you have multiple properties and you have things that carry over from one to the other, that's a situation where you could be overinsured. Sometimes an owner will look at the property values and feel like the property values are overinflated over what they know it would cost to replace that building. And so the things you can do is, if you feel like the property value is truly inflated, and you say, if this building burned to the ground today, how much would it actually cost me to rebuild it from scratch? You can go to your agent and you can ask to review the property attributes, because it's all just a calculation, right? We're taking the square footage, we're taking the finishes. Do you have marble countertops, or do you have, quartz countertops? Do you have hardwood floors, or do you have carpet? It's all just a calculation that goes into a model that tries to calculate, based on your area where you live and your geography and all those factors, how much is it going to cost to rebuild this building? And so if you feel like it's just totally out of whack and you know that that's not going to be the case, sit down with your agent and go through the attributes that have been entered for that property. Maybe some things got overinflated. Like maybe they indicated that it was high-end finishes and it was actually average finishes. And so you can make some adjustments to the inputs. And then that ultimately impacts the overall value of the property. But I'd say some people do get sticker shock when they look at the valuation on their insurance policy, because they'll say, well, I only paid, $100,000 for this property and you're insuring it at $250,000. The question isn't what is the market value for this property today? The question is, if your building burnt to the ground, what would it cost to rebuild it from scratch, given current construction costs, current finishes, things like that. So going back to your question about what can somebody do to kind of save money, let's say you have an older home that has some really, really cool finishes. Maybe it's a 1940s home. It has really cool features, but if something happened to it, you wouldn't necessarily try to restore it in that same manner. You would be fine with, regular drywall. You would be fine with plain old hardwood floors. You wouldn't need to do like the paneling around it. You can ask for an endorsement onto your policy that is only going to cover functional replacement cost instead of actual replacement cost. So that's a way to save money if you don't have an emotional attachment to, I want this exactly the way it was before with those same, 1940s finishes. That's going to be really expensive.
Who are those folks?
Historic, they have historic buildings.
But unless they have listening, folks, much appreciation for restoration. But unless you have pictures of it and you documented it and they did not burn inside your property with the property itself, how to rebuild it is just, I don't see it. So then it comes down to claim it or not claim it, right? That's the question here. And sometimes you need to bite the bullet and do not file your claim. Otherwise, your premium is going to go high. What I'm hearing it, and correct me if this is just like fake news, is that if you claim it or you don't claim it, you get prepared because your premium is going up. Is that something that there is truth behind it or not?
I'd say there's definitely some truth behind it. If you look at somebody who has had 0 claims and you compare that to somebody who has had 3 reported claims but no payouts, the person who has had 0 reported claims is still preferred. So it isn't necessarily that you're going to be surcharged. You're not going to get a penalty that they're going to charge you in your renewal for having had a claim, but it does sometimes put you in a different class of insured from somebody who has never reported a claim versus someone who's reported claims but didn't have any payouts. So you want to walk a careful line. If you are very, very sure that this claim is going to be beneath your deductible, you're just going to take care of the expenses yourself, then it does sometimes make sense not to report it, just take care of it, and you really only consider your insurance for the higher things. But where you need to be careful is your insurance policy does have a duty to report clause, which means that if you if it turns into something bigger and you find out 3 months down the road, once you open up the walls that, oh my God, this is 5 times the size I thought it was. Now I want to report it to my insurance company. If too much time has gone by between when you found out about the claim and you reported it to your insurance company, that can also jeopardize coverage. So you kind of want to walk that fine line. If you're really sure, then don't report it. But if there's any chance that it could become something bigger, then you do have a duty to report it to your insurance company.
Yeah, makes a lot of sense. And Datha, I know that you co-founded this company, Steadily. So you've probably seen your share of stories, people coming in, and success stories of saying, because I had XYZ insurance, it saved me XYZ, so I'd love to hear a story. So one of your favorite customer stories of really in the trenches of, whether their asset was protected, whether it saved them money or it did something else positive. But investors like to know those types of things. Like how did having the right
I thought
insurance.
you were going to ask like horror stories.
Horror stories. I'm going with the success story. I know. I don't want a horror. You could give that one to me too, but I'd love to hear like a success story of like, this is what they had and this is how it helped them so that they can grow their wealth. Cause that's what women want, right? So badly. We have these things in our world so that we can grow our wealth and protect it. So I'd love to hear something you have in your toolbox there.
Yeah. So we had this investor who had a property that they were renovating. And it was very, very close to the end of the renovation term. They had a short-term policy. These renovation policies, they don't run for a year, right? They run for like 3 months because that's the expected renovation term. And she only had maybe a few more weeks before she was going to close on this loan. And so the temptation was, the renovation's done. I'm so close. I'm about to sell this. Am I really going to go get another policy for another 3 months over this whole thing? And so that was kind of the war that she was thinking of. But she called us, explained what was going on. Hey, I've only got 2 more weeks. And so what we were able to do for her was instead of writing her another 3-month policy, we wrote her just an extension on that policy for just another month. And so it wasn't like the full premium. It was just a portion of the premium that she had to pay for that next month. And then she had a claim right before closing. And because she had extended that insurance, it was covered and everything was fine. She was able to get the repairs done. They closed. Everything was fine. But had she chosen to cut corners and just say, well, it's only 2 weeks, it'll be fine, she would have had no coverage and that would have come out of her profit right before she had to close on this loan because she had to get it, or on the sale because she had to get it repaired. So that's an example of where just having a good agent, doing the right thing, understanding what your options are really does make a difference.
So for those folks that are like shaking right now and just like, where is my policy?
I know that's what I'm thinking about. I'm like, that's exactly where my head is right now.
Sometimes policies expired if you don't have a great relationship with your insurance company, if you didn't renew, something happened. So let's say the situation is my policy expired. And can I backtrack? What do I need to do at this moment to make sure that I'm covered? If I backtrack, what are the costs for it? Or let's just go from here and pray that nothing happens?
Well, the answer is it depends. The insurance company is under no obligation to let you backdate a cancellation. However, sometimes it is possible. If you have a really good explanation, if you have an agent who can advocate for you and go to bat for you with the insurance company to try to get you help, if it's within a short period of time, let's say on average, if it's within 2 weeks, there's a pretty good chance that you might be able to get the underwriter to approve backdating. And so then your policy can continue on without a lapse. One thing they are going to ask you for is a signed statement that there have been no losses. So if you let your policy lapse and then you had a claim and then you try to get it backdated, you're out of luck. that's not going to happen. You have to sign a statement. And if then you came back later and said, oh, wait, I did have one. We have your signed statement. You're out of luck.
Or they can just say, oh, I didn't know.
Yeah, I wouldn't
those
play
are
that
the
game.
moments where people have a lot of amnesia, right?
Yeah, right. In other cases, if you have let it lapse, you can still get insurance. So you should still call your agent, do it sooner rather than later, because the longer it goes where you've been in a lapse of coverage, the worse it looks, because it speaks to accountability and responsibility of the owner. And so there are companies that will not insure someone who's in a lapse of coverage. They will not write a new policy for you. So now you've already limited which carriers you can go to. And potentially the ones that will write you are going to charge a little more, because in their minds, they're thinking, well, this is someone who could let this happen again. If they're dropping the ball here, where else could they drop the ball? So fix it as quickly as you can versus letting it drag out. Because it does matter. If you go over 30 days, it matters. If you hit 60 days, it matters. So talk to your agent. There are carriers out there who will write it. You may not like that the premium is going to be higher than what you were paying before, but at least you'll be protected and get it taken care of.
I think that's so important. It's such good advice for the women listening, because we often think short term and we don't think long term. And it is about protecting what we have, but it's also about growing what we have and buying that next property or that next few properties. And so we can't do that if we're not going to be insurable or on paper. So I think that's a really, really good point to stress to everyone listening, especially the women who are a little more risk taking, a little more quick start, and kind of live in the now. That type of personality definitely needs to hear that. Datha, I'm really, really interested to hear your perspective as we come to a close. What are like the next couple of steps that women can do, the listeners can do in hearing this episode? Because, some people are like, this is great. And then they get into their next thing to do after this, and they've forgotten pretty much everything that they just listened to, and they take no action. And so something we really stand upon at the InvestHER community, and everything Andressa and I do with the women in our community, is do something with what you're learning, especially in our podcast. So I'm curious, when it comes to this topic, what is that next step? What is that moving the needle step that everyone listening can take as a result of today?
Well, pull out your policy and take a look at it. It is a lot of legal jargon, so it's totally understandable if your eyes glaze over when you pull it out. But reach out to an agent, reach out to Steadily. Come to Steadily.com. One of our live agents, it's a person. They're going to reach out to you. They are a licensed agent. This is all that they do, is investor insurance. So this is where we specialize. And let them do the heavy lifting. Send them a copy of your policy and have them look at it and see how it would potentially be different from what they would suggest, or what we typically see from investors, and let them kind of point out some areas or some flaws in your current policy. You can do that.
I like that a lot, because I'm just like, wait a minute. I don't even know if I know how to interpret those jargons. And I don't know if my interpretation is correct.
Yep.
And you don't even want to. You don't even want to. You don't want to be the expert in insurance, right, Andressa? I mean, unless you do.
I don't. No, I don't. No, I just want to know the link so I can download and upload and schedule a call. And if somebody says, you look great, actually, you're good to go. Great. So I have the peace of mind. But then if there are certain things that I did not take in consideration, or things changed, this long-term rental is now short-term rental. This long-term rental is now mid-term rental, or vice versa. I think people are keeping the same policy and changing the exit strategies, and they might be shooting themselves on the foot with that. So I want somebody to go in and say, first, let me tell you what's going on in my business now, not then. And take a look at my policy. Let me know, do you see something? And then go from there. But I think that just like sitting and just like, I'm good. Are you really good? So here's the thing. We're going to put the link on our show notes. And you guys can reach out to Datha, because here's the deal. She's going to be at InvestorCon on June 2nd to 4th. You cannot miss her presentation. Ladies, I'm not going to share a little bit more about what's going to happen there, but this is an opportunity for you to really maximize the profits of your property and make sure that you are protecting the asset that you work so hard to build. That's what the bottom line of it is. And as she said, you can speak with the real people, right? Because we're all tired of speaking with bots and AIs. You speak with real people and really get a hold of her. She's going to be there. She built this company, which we really appreciate speaking directly with founders. It's different. It is different when you speak with founders and people that fully understand. So I welcome you guys to come. What people can expect from your presentation, Data? Don't give too much, but what they can expect.
Well, I try to be interesting, not boring. So I'm going to teach you about the basics of insurance as it pertains to your investment properties without being boring about it, just to give you enough so that you understand, kind of open the black box. We're going to talk about cash flow strategies when you're contemplating new properties. What geographies should you be thinking about when you're looking at properties that you might want to purchase? What do you need to think about in the back of your mind when you're doing your ROI calculations? And just help you invest better and help you look at the properties you have to make sure that you're properly covered and you have those assets protected.
I'm glad we're recording each and every one of our sessions, right, Andressa?
Yes. So thanks so much for being on our show. We're looking forward to your presentation and InvestHER Con. Super excited to have you guys.
It was a pleasure. Looking forward to seeing everyone.